Hello, welcome diploma students, mechanical and civil branch. This is the new course, new subject actually introduced by AICT and RGPV in this session. This is engineering, economics and accountancy. So for both of the branches it is similar, same curriculum. So let us start engineering, economics and accountancy. First of all, we have see the what is the course title. Course title is engineering, economics and accountancy. Paper code is 7606, subject code is 622 and theory credit is 03. What is the course learning objective? Course learning objective is here to acquire the knowledge of basic economic, to facilitate the process of economic decision making, and to acquire the knowledge on basic financial management aspect. So financial, what is the different type of aspect of financial management is to be acquired here. To develop the basic skill and analyze the financial statement. So we have take here only unit 1. In this video we have discuss the unit 1. What is inside the unit 1? In unit 1, introduction, first managerial economics, relationship with other discipline, firm, types, objectives and goal, managerial decision and decision analysis. Okay, so let's start. Introduction to managerial economics. So we will start with the definition. Managerial economics. Managerial economics is the application of economic theories, principles and tools to solve the business problem and make optimal decision. So actually managerial economics is a tool which enable us to decide the what to do for a particular type of work. So it bridges the gap between economic theory and business practices. Then what is the scope of managerial economics? The scope of managerial economics is demand analysis and forecasting first, second is cost and production analysis, third pricing decision strategy, fourth profit management and fifth capital management. So one by one we have take this. First, demand analysis and forecasting. Demand analysis and forecasting mean understanding consumer behavior and predicting the future demand. Example, a company like Apple analyze past iPhone sales trend, customer preference and market condition to predict the how many iPhone to produce next year. Means iPhone is a company which want to decide how much product, means how much phone is to be produced in the next year. So it is done by the forecasting by means of survey. So this is second example we have taken over. Also a car manufacturing like Tata Motors need to decide how many electric vehicle to produce based on the market demand, cost and government policies. Managerial economic help them optimize production and pricing. Actually both of the type of example is a different field. First is a telecommunication field, it is directly concerned with the consumer, and second one is the somewhat more prestigious one. However, iPhone is one of the well known in their brand name. Okay. Second is cost and production analysis. Cost and production analysis, analyzing production cost and optimizing resources allocation. Example, here we have taken a car manufacturer, for example Tata Motors, evaluate the cost of raw material, labor and machinery to decide whether producing more electric vehicle is cost effective. So this is the cost and production analysis. Third, pricing decision and strategy. What is the pricing decision strategy? How it contribute in the economic managerial process? Setting the prices to maximize profit or market share. Example, Netflix uses a subscription pricing model where they offer different price tier, basic, standard and premium, to attract more customer while maximizing the profit. So actually what happened, if some company, if particular company, if decide the price for a particular segment of the customer, then they cannot maximize their profit. If they want to maximize the profit, they should take in totality. That's why they have make or kept the different type of pricing: basic pricing, standard pricing, and premium pricing according to the customer. Somewhat middle class families and upper middle class and higher class. So this segment is enhance the maximum profit. Profit management. What is the profit management? Ensuring profitability under changing market condition. Profit management is one of the biggest tool or use in the economic managerial economics is the ensuring the profitability under changing market condition. For example, a restaurant chain like McDonald's adjusts its menu prices and introduce limited time offer to maintain the profitability despite the rising of food cost. Isn't it? Capital management, making investment decision and managerial financial resources. Example, Reliance Industries evaluate whether to invest in a new oil refinery or expand its digital service based on future profit potential and risk. Means when some example here is Reliance Industries is actually deal with oil sector, also in telecom sector. So they have to decide in which they get more profit, then they will decide the where our capital is invested. Means in either refinery or telecommunication or digital services. Similarly, importance of managerial economics help the decision. Importance, what is the importance of managerial economics? Actually it help in decision making under uncertainty, provide tool for analyzing market trend and competition, aids in resource allocation and cost minimization. Because cost is minimized and profit is maximized, then they will be in profit. Relationship with other discipline. What is the relationship with other discipline? This is in your syllabus. The relationship with other discipline means economics, mathematics and statistics, operation research, accounting, marketing, finance. So let's one by one. Economics. Use microeconomics theories, for example demand, supply, elasticity, and macroeconomics concept, for example inflation, GDP, to analyze the business environment. So managerial economics is directly concerned with this economics. Similarly, managerial economics is directly concerned with the mathematics. How it's concerned? Employ the quantitative technique like linear programming, regression analysis, and profitability theory for decision making. How it help the taking decision making? Actually, it help in decision making. Like suppose some companies want to produce table and chair also via their raw material as a wood. Then what? Suppose X is the table and Y is the chair. So how much chair to be produced and how much table is to be produced, means they want to know the quantity, what should be produced, how much should be produced. So they are directly decide by their profit. If the profit is more in the table and in the, rather than chair, then they go to the produced table. So in this way, this makes a complicated linear programming problem in mathematical model, and deciding the value of X and Y means table and chair, and they have go to the decision. Similarly, regression analysis just like we have taken the graphical and decide the how much uh, inclination of line. This is suppose in the y-axis we have taken some data and some data in x-axis and both are interrelated. Then we have to decide where we have plot the line between these two data and find out the tendency of this line, whether it is inclined towards x-axis or y-axis or what's the nature of this line. Then we have to decide the other making decision making process. So this is a regression analysis. Sometimes operation research is the optimization model problem and related to the production, inventory and supply chain. Similarly, accounting provides the financial data for cost analysis and budgeting, profit planning. Marketing means help in understanding the consumer behavior and pricing strategies and market segmentation. Similarly, finance is assist in capital budgeting, investment decision and risk analysis. For example, a startup like Zomato use the capital budgeting to decide the new investment. So this is the direct concern with the other discipline. Now come to the first type, firm type and objective and goal. Firm, how many types of firms there and objectives of what and its goal. So type of firm we have taken first. Sole proprietorship. Proprietorships means sole, means they are owned, managed by single individual. Partnership, owned by two or more person will be there, means business between two or more person, and profit and liabilities is sharing between them. This is the partnership. Corporation means corporation means legal entities separated from their owner, means when a type of group involved and somewhat public also is contributing somewhat, this is called the shareholders and this is stakeholders. This is a formation of corporation. Example, Tata Motors, Reliance Industry, Infosys, and this is like that. And cooperative means a specific type of group or individual formulate the their business. This is the mutual benefit. This is individual for mutual benefit. It is the cooperatives. That's like this Amul, because Amul dairy is a milk product is there. Amul solely cannot do produce milk product. Lesser or means without the involvement of villages persons, because the villagers give the milk them and then he produce the dairy product. That's why this is the cooperatives. And similarly, objectives of firm. What is the objective firm? Profit maximization. Primary goal of the most firm is achieved by the maximize the revenue and minimize the cost. It is profit maximization, as earlier I have said. Similarly, sale maximization, focus on the increasing market share and sale volume. Revenue maximization means prioritizing total revenue over profit. Social responsibility means contributing to societal welfare and environment sustainability. Long term survival, ensuring sustainability and growth over time. And what is the goal of firm? Goal of firm is short term goal, increasing quarterly profit, launching new product. Long term goal, expanding market share, building brand loyalty. When what is the managerial decision? We have talked about what is the managerial decision. Managerial decision involve choosing the best course of action from available alternatives. The key areas include production decision, pricing decision, investment decision and human resource decision. And what is the production decision? Means what to produce, how much to produce and which technology to use. For example, Tesla decide how many Cybertruck to produce. Pricing decision means setting up price based on the demand, competition and cost. Everyone knows that the cost of production is the one of the main factor to decide the pricing, but sometimes it also governed by the competition and demands. The competition in the competition segment, if we talk, some cutthroat business is also in the in their business, cutthroat business in the type of a business also, because in that business the pricing is lesser and means it is negative profit, but because down the frontier or our competitor, they decide this type of business. However, this is not a negative one, we had not talked about, but pricing decision is the decision not only depend on the cost but also competition and demand also. And strategies, therefore it is also called a strategy. And strategy means penetrating price, means initially what price to be set down, skimming prices and a dynamic pricing. For example, Uber and Ola, this is, they use dynamic pricing. Also airlines also use the dynamic pricing, means the higher fare during the peak hours. Investment decision means capital budgeting and allocation of resources, evaluating project based on return of investment. For example, goods investing in AI startup. Human resource decision, hiring, training and retraining employees, ensuring optimal workforces productivity. Example, Infosys hiring in training software engineers. Market decision, product design, promotion and distribution strategies. For example, Coca-Cola launching an ad campaign for a new soft drink. Decision analysis. Decision analysis is a systematic approach to making business decision under uncertainty. It involves step in decision analysis, define the problem, identifying the alternatives and evaluate the alternatives. Define the problem is clearly identify the decision to be made. For example, a startup deciding to enter a new market. Identifying alternatives means list all the possible courses of action, like expansion of our business in USA, Europe, and decide after that if we will stay in the India. So evaluate alternatives. Evaluate alternatives means use quantitative and qualitative criteria to access the option like market size, competition and cost. Fourth, choose the best alternatives. Among these alternatives what you have drawn earlier, then you have to choose the best alternative. Select the option with highest expected value or utility and implement and monitor. Execute the decision and track the outcome. Tools for decision analysis. What is the tool for decision analysis? Decision analysis incorporated with this tool means decision tree, payoff matrix and break-even analysis. Decision tree, just like a graphical representation of decision making scenario, help in evaluating the risk and reward. And payoff matrix means compare outcome of different decision under various state of nature. And break-even analysis is also one of the graphical representation, determine the point at which total revenue equal the total cost, somewhat mathematical and graphical also. Example here is decision tree means, this decision tree means just like to prepare a tree. There are two things only, either true or false, nothing third. There is only two alternatives, false, either false or the true. Suppose temperature 15 degree, either it is true or it is false. If it is false means there will be rain, and it is true there will be sun, means whole day will be brightened and sunny. So suppose again this is true and false, means if rain, if false means sweating is there. and true means umbrella will use there. Sun is false means sun, if it is sun is not there means the cold will be there, then sweater will be used. And if it is true, the t-shirt is very it, comfortable for that. So every decision means has the two thing, either yes or no, not third thing. This is just a decision tree. Similarly, payoff matrix means suppose two player is there and three things is there. So what types of matrix will be there? 3 by 3 matrix will be there. And one most of the students knows that what is rock paper scissors is the game. Rock paper scissors. And if you acquainted with this, with suppose player 1 and player 2 also give rock and rock, then 0 will be there. Suppose player 1 and player 2 give paper and paper, 0 0 will there. And scissor and scissor, then also 0 0 will there. If what the combination will be there, if rock and paper, then minus 1 1, because paper and rock will cut down it. And similarly rock means stone, it will help hide the paper. So this is the thing. And scissor will cut the paper, then 1 minus 1. So this is the combination. We have to find out just the combinations from the alternatives. This is the payoff matrix. And break-even analysis. Break-even analysis is somewhat mathematical and graphical representation. This is you have noticed here that suppose this is the x line, x axis, and this is y axis. If we take in the y axis the sales, and this is the number of units sold, then it has two cost. One is variable cost and one is fixed cost. Means particularly one know that this is the fixed cost. It is involved either we have produced 1 unit or 100 unit. So this is the fixed. This is called fixed cost. And variable cost is variable because they is used a number of product individually. Suppose this is the variable cost. And if we plot the graph between these two, so we have find that where it cut down, and where it cut down means at this point this is match with the variable and fixed cost. And after that we have to decide that this point is one of the break even point. Beyond this point we have neither at this point we have loss and profit is 0, means neither loss nor profit, means after that we will have the in profit. This is shown by this. And otherwise if we produce lesser of this point, produce of our number of product, then we have in loss. So this is the break even point analysis. What is the marginal analysis? Marginal analysis means after getting benefit we have to expand marginally our business, then it is called the marginal analysis. Compare additional benefit with additional cost. Example of decision analysis: if firm decide whether to launch a new product, alternative launch, now, delay, launch or abandon, means either we have to start, continue, or go ahead or go back. Criteria: market demand, competition, cost, production. Based on this criteria we have to decide. Decision: choose the alternatives with the highest expected profit. Teaching tools and technique. Now come to the question and answer related with this first unit. Question first: what is managerial economics and how does it differ from the traditional economics? Answer is: managerial economics applies economic theory and method to decision making within organization, unlike traditional economics which focus on broader economic system. Managerial economics concentrate on solving a specific business problem. It bridges the gap between economic theory and business practice. Question number 2 is: how is managerial economics related to other disciplines like accounting and statistical? Answer is: managerial economics draw heavily on accounting for cost analysis, financial data and performance of management, statistical for data analysis, forecasting and risk management. It also uses concept from mathematics and decision science. Third question, what are the primary types of firms and how do their objectives typically differ? Answer is, common type of include sole proprietorships, partnerships and corporations. Objectives can vary. Small firms may prioritize survival while large corporations often focus on profit maximization or shareholder wealth. Modern firms are also focusing on the social responsibility. Fourth question, what are some common objectives and goal of a firm? Common objective includes profit maximization, sale maximization, growth maximization, market share expansion, increasing shareholder wealth and social responsibility. Fifth question is, what are the managerial decision and what factor influence them? Managerial decision are choice made by manager to achieve organizational goal, and factor influencing them include market condition, resource availability, competitive pressures and legal and regulatory constraint, internal company policies like this. Sixth question, what is the decision analysis and why is it important in managerial economics? Decision analysis is a systematic approach to making choice under uncertainty. It's crucial in managerial economics because it provides tool and technique to evaluate alternative courses of action and select the optimal one. Question number 7, give example of managerial decision that require the use of economic analysis. Answer is pricing strategy, production planning, investment decision, market entry to exit or an resource allocation. Eighth question, how does the concept of opportunities cost related to managerial decision making? Answer is opportunity cost, the value of the next best alternative foregone, is essential. Managers must consider the potential benefit they give up when choosing one option over another. Ninth question, how can demand forecasting be used as a tool in managerial decision making? Answer is demand forecasting allow manager to predict future sales, which is vital for production planning, inventory management, financial planning and marketing strategy. The last question is, what role does risk management assessment play in managerial decision analysis? Risk management involves identifying and evaluating potential risks associated with the decision. It helps manager understand the likelihood and impact of adverse outcome, develop strategies to mitigate risk and make more information decision. So enough for this video, and this is first this was the first unit, and the next video we will introduce the second unit in English.